Hello, my name is Fabian Ding. I am the owner of FMD Wealth Advisors. This is my podcast, Don't Screw Up Divorce. I'm a certified financial planner, chartered financial analyst, enrolled agent with the IRAs, certified divorce financial analyst, and certified quadro specialist. I'm helping people that are going through major life transitions like divorce. I'm supporting my clients before, during, and after divorce, and I work with clients nationwide. If you would like my help, click the link in the show description or visit fmdwealth.com to schedule a call with me. We are open for business. So, what is the topic in this week's podcast? So, the topic is dividing retirement accounts in a New York divorce without derailing your retirement plan. So for most high net worth households, the single largest asset is not the house. It is the combined balance of retirement accounts, 401ks, IRAs, deferred compensation, and pensions. When those accounts have to be divided in a divorce, the work is not simply mathematically. Retirement accounts carry tax characteristics, withdrawal restrictions, and growth assumptions that make them fundamentally different from cash. Splitting them as if they were cash quietly throws away value. The way retirement assets are divided also shapes the rest of your retirement plan. The years you have left until retirement, the lifestyle you're planning for, and the level of income you will need in your 70s and 80s all interact with the structure of the divorce settlement. This is the area of a divorce where careful financial planning has the most loop-sided payoff. The settlement that looks fine on the day it is signed can be the settlement that leaves one spouse short a decade later simply because no one modeled out what the accounts would actually do over the years that follow. The good news is that there are well-established ways to divide retirement accounts thoughtfully. The bad news is that those methods are not the default. You have to ask for them. So now, let's talk about why retirement accounts are marital even if only one spouse earned them. So a common misconception is that a 401k or a pension belongs to the spouse who earned it. From a financial planning standpoint, that makes sense. But from an equitable distribution standpoint, it does not. Under New York's domestic relation law, 236, retirement contributions made during the marriage, along with the growth on those contributions during the marriage, are marital property, regardless of whose paycheck funded them. What is generally separate is the portion of the account that was funded before the marriage, plus the growth attributable to that premarital portion. So tracing that premarital portion is essential, and it requires statements from the date of the marriage forward. If the account is old and the premarital documentation is incomplete, a forensic accountant can sometimes reconstruct it from contribution history and market-based growth assumptions. This work is rarely needed in most cases or in modest cases, but in high net worth situations involving older accounts, it can substantially change the split. So let's talk about the tax difference between different types of retirement accounts. Not all retirement dollars are equal, and one of the most important pieces of preparation is recognizing what kind of dollars are in each account. Traditional 401ks and traditional IRAs are pre-tax. They will be taxed at ordinary income rates when withdrawn. The headline balance overstates the spending power because the future tax has not been deducted. On the other side, Roth 401ks and Roth IRA dollars are after tax. They were taxed when contributed, but qualified withdrawals are tax-free. The headline balance accurately reflects spending power. Pension dollars, on the other side, are pre-tax future cash flows, with the additional wrinkle that they are tied to retirement age and longevity. Their present value depends on the recipient age, the plan's payout structure, and actuarial assumptions about life expectancy. Splitting these account types in equal nominal amounts ignores the tax differences. A spouse, for example, who walks away with a $1 million in a Roth account has meaningfully more after-tax wealth than a spouse who walks away with 1 million in a traditional 401k account. A fair split adjusts for that. Talk about pension valuation. So that's the hardest part. Defined pensions, defined benefit pensions, are the most challenging retirement assets to divide, particularly in cases involving long careers in a field of medicine, law, finance, or the public sector. The pension promises a future stream of payments rather than a current balance. To divide it now, an actuary or specialist firm has to convert the future stream into a present value using assumptions about retirement age, life expectancy, payout options, and discount rates. Different assumptions, of course, produce different present values. A pension can reasonably be valued at one figure under conservative assumptions and a meaningful different figure under aggressive ones. So in New York, specialist firms that focus on pension valuations are commonly retained to perform this work. The pension can then either be offset against other marital assets. For example, one spouse keeps the pension, the other keeps an equivalent value in liquid assets. Or divided by a so-called qualified domestic relationship order, quadro, QDRO, which each spouse drawing from the pension at retirement. Which approach is better depends on the rest of the estate, the relative age of the spouses, and the appetite for ongoing entanglement with the former spouse's retirement payout. So now, let's focus on the quadro that I mentioned earlier, qualified domestic relationship order. What is this? So now, this is a procedural step that cannot be skipped. When a qualified retirement account, for example, a 401k, or a defined pension benefit is divided in divorce, the division has to happen through a qualified domestic relationship order, or quadro. A quadro is a court order that directs the plan administrator to split the accounts between the two spouses without triggering taxes or penalties. Without a quadro, transferring funds out of a qualified plan creates a taxable distribution to the account holder, often followed by early withdrawal penalties. Quadros are technically documents. The plan administrator has to accept them, the language has to match the plan's requirements, and the timing has to be handled correctly. They are often drafted by specialist quadro firms rather than by the general attorneys. The most common quadro mistake is treating the quadro as a post-divorce afterthought. So by then, account values have changed, plan administrators have moved on, and the divorce attorney may no longer be actively engaged. Quadros should be drafted in parallel with the settlement, not after it. So let's focus on IRAs and the incident to divorce rules. So IRAs are split differently from qualified plans like 401ks or defined benefit plans. They do not require a quadro. That's important. Instead, a transfer from a spouse's IRA to the others made pursuant to a divorce decree or separation agreement qualifies as a tax-free transfer under what the IRS calls a transfer incident to divorce. This mechanic is simpler, but the same tax principle applies. Traditional IRA dollars and Roth IRA dollars are different. Inherited IRAs have their own rules. Backdoor Roth contributions made during the marriage may have their own basis tracking complications. So if the IRA portfolio is significant, do not split it as if it were a pile of identical dollars. Look at each account, each asset class, and each tax characteristics separately. The transfer is simple. The decision about what to transfer is not. So now, let's answer the question why a settlement should be modeled, not just negotiated. So retirement assets are the part of a divorce settlement that compound for the longest time. A decision made today can grow or shrink in ways that changes the entire post-divorce financial picture. So before signing, you should have a model that projects each spouse's retirement accounts forward with reasonable assumptions about contributions, growth, withdrawals, and taxes. That model tells you whether the settlement supports the retirement you are planning, you envision for you, or it quietly underfunds it. The model also lets you compare alternative settlements on equal terms. For example, trading more 401k for less house, trading the pension for liquid assets. Each of these has a different long-term shape, and the only way to see the shape clearly is to model it. A certified divorce financial analyst, CDFA, can build the model with you. It is one of the highest leveraged pieces of work in the entire divorce process. Retirement accounts obviously are not just numbers on a balance sheet. They are the engine of the rest of your financial life. The way they are divided in a divorce shapes how that engine performs for the next 2-3 decades. The right approach is not to argue over the largest possible balance today. It is to design a division that supports the retirement plan you actually intend to live. So now, what is important? Get the tax characteristics right. Get the quadro drafted in parallel with the settlement. Model the long-term shape of the division before you sign. None of these steps are dramatic, but together they are the difference between a retirement that holds and a retirement that has to be rebuilt. So now, let's focus on some frequently asked questions I receive from my clients. Will dividing my 401k trigger taxes? Well, not if it's done correctly through a qualified domestic relationship order. A properly executed quadro transfers the agreed share to your spouse's accounts without triggering taxes or early withdrawal penalties. The receiving spouses then owes taxes on the funds only when they withdraw them in retirement on the normal schedule. Transfers done outside of a quadro, however, are taxable distributions and are often carry penalties. So, next question. What happens to my pension if I'm not yet retired? Well, there are two general approaches. The first is to value the pension now using assumptions and calculations and offset it against other marital assets. So one spouse keeps the full pension and the other takes an equivalent value in a different asset. The second is to divide the pension itself via a quadro. So each spouse receives a defined share when the payment begins. Which approach it's better depends on the size and structure of the pension, your relative age, the rest of the estates, and how much continued entanglement with your former spouse you are willing to accept. So, next question. Can I roll my share of my spouse's 401k into my own IRA? Yes. Once the quadro is executed and the transfer is complete, you can roll the fund into your own IRA without triggering taxes. This is often the cleanest approach because it gives you full control over the investment selection, withdrawal, timing, and beneficiary designations going forward. Be careful about the timing and paperwork, however. A misstep can convert the tax-free rollover into a taxable distribution. So, what is the last question that I get asked? Should I keep more retirement assets in exchange for less of something else? Well, maybe, but it depends on your full financial picture. Retirement assets have powerful long-term growth potential, but are not liquid until retirement age. If you need cash flow now, for example, to cover housing, child-related expenses, or career transitions, trading too much current excess wealth for retirement assets can leave you stretched in the short term. The right balance depends on your age, your income, your other resources, and your plans for the coming years. Modeling the trade before agreeing to it is essential. So, this was this week's podcast, Don't Screw Up Divorce. My name is Fabian Degen. I'm the owner of FMD Wealth Advisors. I'm a certified financial planner, chartered financial analyst, enrolled agent with the IRAs, certified divorce financial analyst, and certified quadro specialist. I help people that are going through major life transitions like divorce. I'm supporting my clients during, before, and after the divorce, and I work with my clients nationwide. If you would like my help, click the link in the show notes or visit fmdwealth.com to schedule a call with me. We are open for business.